The NVIDIA Corp stock ticker, NVDA, is currently trading at $192.36 as of 11:30 a.m. EST on Tuesday, November 11, 2025, reflecting an intraday drop of negative 3.36% from the previous close. Now, most people see that red number, a drop of almost 3.4%, and their immediate thought is that the air is finally coming out of the AI trade bubble, especially given the news that SoftBank sold its entire $5.83 billion stake. That's the expectation. A massive institutional sale by a known tech investor means the smart money is walking away, validating the fears about an overstretched valuation. But here is the critical insight that the surface-level reporting misses. The SoftBank sale, while large in dollar value, was a pre-arranged exit that was highly anticipated and largely absorbed by the market over the past couple of weeks. The real anchor on the stock today is a sudden, sharp cooling in sentiment surrounding smaller AI infrastructure players, following disappointing guidance from CoreWeave, a key customer for NVIDIA's high-end chips. This shift immediately introduces a curiosity loop. Is the decline a structural problem, meaning the entire AI spending cycle is slowing, or is it merely a reflection of overvaluation risk in the smaller companies, a risk that a giant like NVIDIA is perhaps uniquely positioned to weather? The reality is much more nuanced than a simple bear market signal, and it forces a closer look at the actual mechanics of the AI supply chain. The prevailing market belief about NVIDIA stock is straightforward. It is the undisputed king of the AI data center, the essential hardware vendor whose GPUs, specifically the A100 and the newer Blackwell generation chips, act as the literal engine of artificial intelligence. This belief has propelled the company's valuation into the multi-trillion-dollar territory. The common narrative holds that as long as Google, Microsoft, Amazon, and Meta are in an accelerating arms race to build out their AI compute capacity, NVIDIA's data center revenue is effectively bulletproof, driven by unprecedented demand for their high-margin, purpose-built hardware. However, a deeper look reveals a substantial vulnerability that the market often discounts, and it's right there in today's price action. The contrarian take is this: the enormous growth numbers are creating an inherent pressure on its largest customers to find alternatives, and not just in the future, but right now. The news about SoftBank selling, while already priced in, combined with the CoreWeave guidance concerns, points to a growing anxiety about the sustainability of margins. When a major service provider like CoreWeave signals caution, it suggests that the massive capital expenditure required to acquire NVIDIA's most advanced hardware is starting to meet resistance on the return on investment side. This is the subtle tension. Is NVIDIA selling a product that creates limitless value for its customers, or is it merely selling a product at such a high price that it begins to choke the economics of the entire ecosystem? If the latter, it sets a dangerous precedent for future orders, even from the biggest hyperscalers. Drilling into the recent stock movement, this latest daily swing of over 3% downward is part of a broader consolidation phase that has followed the stock's parabolic ascent. Over the past 3 weeks, the volatility has spiked. We saw a solid recovery from a dip in late October, fueled by renewed optimism about the Blackwell product cycle, only to hit a wall near its 52-week high of $212.19, set just 2 weeks ago. The current trading volume, which has been elevated but not outright panicked, indicates significant institutional shuffling rather than a retail stampede for the exits. This is not the clean, high-volume breakdown of a burst bubble. It's the choppy, nervous trade of institutional accounts trying to readjust their high-conviction positions. There's a constant tug-of-war between the long-term thematic investors who see the multi-year secular trend of AI adoption as an unbreakable tailwind and the more tactically minded hedge funds who are worried about quarterly lumpiness and the inevitable mean reversion following such historic growth. Technical indicators are starting to cool off from previously overheated levels, suggesting the stock might be entering a period of sideways movement as investors await the next major catalyst, which in this case is the upcoming earnings report expected in just a few days on November 19th. Institutional ownership remains massive, with major firms like Vanguard and BlackRock holding billions of shares. But the quarter-to-quarter filings show a mix of slightly decreased and increased positions, indicating a lack of unified conviction at the very top. This is a stock at a crossroads, where its own success has made its price highly sensitive to any noise in the broader tech and macroeconomic environment. Macroeconomic pressures are adding further complexity to the NVIDIA stock price action. We've seen persistent concerns over inflation and the path of interest rates casting a shadow over high-growth technology stocks, particularly those with valuations that are heavily reliant on future earnings growth. Higher borrowing costs make the colossal capital expenditure plans of NVIDIA's data center clients more expensive, indirectly placing pressure on the demand side. The government shutdown concerns and delayed economic data releases have only amplified this general market uncertainty, pushing investors who favor certainty towards safer assets or more defensive sectors. Furthermore, the persistent and growing regulatory scrutiny, particularly concerning the export of advanced chips to China, is a constant overhang. The U.S. government's restrictions force NVIDIA to create watered-down, country-specific versions of their flagship GPUs, a move that introduces significant execution risk and limits the company's access to what would otherwise be a massive market. This is a prime example of expectation versus reality. The expectation is global dominance, but the reality is that geopolitical tensions are segmenting the market and forcing the company to expend valuable R&D resources on compliance-driven products, which can dilute the pure-play AI narrative. The fact that the stock is now dipping on news about a smaller customer's troubles, combined with the general sector weakness shown in other AI-linked stocks, highlights how sensitive the entire ecosystem is to any perceived slowdown in capital spending. This is where investors who manage their individual brokerage accounts, perhaps through platforms like Fidelity or Interactive Brokers, need to be especially cautious, differentiating between genuine market-wide weakness and idiosyncratic company risk. The fundamental expectation surrounding NVIDIA rests almost entirely on its data center segment, which has aggressively eclipsed its traditional graphics segment, the one famous for its GeForce GPUs and professional visualization products. NVIDIA's core business model has evolved from a chip company to a full-stack AI infrastructure provider. They don't just sell the hardware, they sell the CUDA software platform that acts as the operating system for AI, creating a formidable switching cost for clients. This closed proprietary ecosystem, while a source of immense profitability, is also the single greatest point of tension in the market. Its graphics segment, including the gaming market, still makes up a meaningful portion of revenue, but the growth story is unequivocally the compute and networking segment, which now accounts for the vast majority of total sales. The data center segment includes the highly coveted GPUs, the Mellanox networking technology, an acquisition that proved perceptive, and a growing suite of software services like NVIDIA AI Enterprise. Past reports confirm this shift. While gaming was once the primary driver, the data center's revenue growth has been exponentially higher, consistently crushing estimates and driving the stock price up. They are now an indispensable partner to organizations building out capabilities in generative AI, large language models, and high-performance computing, not just in cloud infrastructure, but also in specialized areas like automated driving and robotics through their automotive and embedded platforms. The success of this model is why when you look into online investment discussions, whether on Fidelity's individual brokerage platform or when reviewing advice on investing sites, NVIDIA stock is invariably presented as the foundational bet on the future of computing, often mentioned alongside Apple stock and Tesla stock as a must-have technological behemoth. The ability to command such a massive price for their chips is directly tied to the stickiness of the CUDA platform, a fact that both retail Invest Online users and sophisticated managers running Fidelity wealth management strategies acknowledge as the core competitive advantage. Looking ahead, the future outlook for NVIDIA stock is less about whether AI will continue to grow and more about who will benefit from that growth and at what margins. The expectation is that the upcoming Blackwell chips will create another super cycle of demand, further cementing NVIDIA's market share. However, the reality is that two primary disruptive forces are rapidly gaining momentum. First, the hyperscalers, Google, Amazon, and Microsoft, are all developing their own custom silicon, TPUs, Inferentia, and Maya, to reduce their dependence on NVIDIA. This trend has the potential to shave off a substantial chunk of NVIDIA's highest margin sales over the next 2 years.